What is BlackRock Investment Institute?
BlackRock, we are running around 14 trillion US dollars across very many different investment strategies.
One very interesting phrase which you used in our conversation earlier was diversifying the diversifiers.
Diversify the diversifiers we think is critical, and gold can be an important part of that moving forward.
A trend which we've seen in Indian markets is a lot of retail flows into Indian equity markets.
If we focus on the equity side, roughly 5 trillion market cap is very huge. So I think of the SIP is almost like the heartbeat, and India is adding this every year. So by the end of the decade, India, if all goes to plan, should be the third largest economy in the world.
Welcome back to Meet the Experts. I'm your host Rahul Midha, and I have another very special guest with me today, Ben Powell. Ben is the Chief Investment Strategist for Asia and Middle East within the BlackRock Investment Institute group. Welcome to the show, Ben.
Thanks very much for having me. Great to be here.
Ben, for our India audience that's discovering BII for the very first time, what is BlackRock Investment Institute? What does it publish, and how is it unique?
I think it is unique, actually, Rahul. So what is it? We are very privileged. We are in a very fun and interesting position. The BlackRock Investment Institute, we have the luck and responsibility to sit in the middle of the world's largest asset manager. So as you may likely be aware, BlackRock, we are running around 14 trillion US dollars across very many different investment strategies. So we probably have hundreds of fund managers from Shanghai to Sydney to San Francisco, all over the world. So this is great. So the challenge is, how can we make sure they are all in some communication, learning from each other, taking the best of each other's amazing insights on what their particular expertise is, and then applying it into their own portfolio. So we at the BlackRock Investment Institute, we sit in the middle of this BlackRock very huge investment platform, and our responsibility is to help the information flow around the firm for the benefit of our investor. Furthermore, the firm decided 10 years or so ago that if it is useful for our own investor, then maybe it can be helpful for our clients. And we therefore publish many different bits and pieces, including quite recently our Global Outlook, where we are attempting to synthesize, really aggregate the wisdom of the investment platform from the world's largest asset manager by far, and to bring it into one coherent, useful view and frame, exploring, of course, the big question on artificial intelligence and geopolitics. Maybe we will come to some of these later, but really trying to help real people with their portfolios, what can work for them, and what can help them achieve their financial goals, be it putting kids through school, be it funding retirement, whatever it can be. Everyone needs to have a portfolio that can work for them. So we are trying to aggregate the wisdom of the BlackRock investment platform, bring it into hopefully a easy to understand, consistent portfolio framework, and then talk about it with important clients and other partner.
Super, Ben. So I think BlackRock Investment Institute, what I'm understanding is, sits at the center of, the different things which BlackRock does. And you also mentioned the Global Outlook, which we'll get into in a minute. But before that, can we talk about the other things which the BlackRock Investment Institute does? More specifically, the Asia Insights. So what does this series cover most frequently? And how should an Indian investor take an actionable insight from what the Asia Insights talk about?
You're right. So we're writing frequently across Asia on where we think there is opportunity.
Yep.
So again, we have a huge kind of scale in Asia, as everywhere else, but in Asia for sure. So we're thoughtful around a range of topic, from the development of capital markets in different countries to how AI is playing out in the China technology ecosystem and so forth. So for an India perspective, we've written a couple of pieces recently on India specifically, where we are laying out some of the structural excitement we have as a firm in terms of the growth of capital markets. In round numbers, India equity market is now $5 trillion. Is a big number. So it's bigger than Hong Kong, roughly the same size as Germany and the UK combined. So it's really a huge scale. So what we are trying to do in the Asia Insights series is to a little bit cherry pick what we think are, there's so many different topics, but we're trying to pick the ones where we feel there is a particular kind of interesting opportunity and a story to be told that somehow is underappreciated by global market.
Thanks, Ben. I think another interesting thing I noticed on the BlackRock Investment Institute website is that in the last few months, you added India-denominated capital market assumptions. So can you tell our audience a little about what are these capital market assumptions and how do you build them?
Yeah, okay. This is a deep question, so I try not to go too long, but I think I need to unpack a little bit. So we do many things. We have, as I say, a very nice responsibility to be at the center of the world's largest investment manager. This is great. Then we are, of course, debating geopolitics, we are debating economics, sustainability, and so forth. So we are doing many things. But the way I put it, Rahul, is we're doing many things, but we're really doing one thing, which is the portfolio. All of this is very interesting and important, but all of it needs to fit into the question, what does it mean for the portfolio? Otherwise, it's just so much hot air, right? So the focus always has to be, what does it mean for the portfolio? And this requires some math. So, of course, we're talking about all of these subjects, but ultimately we need to have an assumption on how much return any particular asset is going to generate. So what we try to do is create portfolio for different country, different currency. So we have, I think, is 14 now. You can find them on the BlackRock Capital Market Assumption website. And relatively recently, we were very pleased to introduce Indian rupee capital market assumption. So what this can do for an investor is show you what we think is a reasonable portfolio for a rupee denominated investor. I want to be appropriately humble. It's not like we think we have a monopoly on truth. We don't think it's like definitively the right portfolio. Of course, this will depend on exactly what the investor needs, what are their particular liabilities they're trying to fund, and so forth. But we hope at the very least is a useful starting point. You know, again, we're trying our best. So we are trying to aggregate the wisdom of the investment platform, BlackRock, very large, put it through a very coherent and consistent framework, and then turn it into number. So again, we humble. We don't pretend that we definitely right, but it is a very serious piece of work. So hopefully when everyone look at the number, they don't have to agree, but it is a sensible thought that we can think about how rupee-denominated investors should structure a portfolio, and maybe in the worst case is a good starting point for a conversation. You know, so rather than just starting the conversation with, you know, words and what do you think, we can start with a portfolio, and then the other side of the conversation can say, why do you think that? And then is a real conversation based on data and real underlying work rather than something more random. So this is core of the BlackRock intellectual property. These capital market assumptions are underpinning our strategic asset allocation views, which are used by BlackRock Investor, and I'm very proud to say are used by many of our important clients all over the world, including here in India.
And I think one of the benefits of Geo BlackRock, Ben, is that we get access to, you know, whatever you spoke about, and thought leaders such as yourself. Talking a little about access, let's hear about you from the 2026 Outlook, which BlackRock recently published. You write that a few mega forces now drive economies and markets, with AI as the dominant theme. You also mention that this means that there's no neutral stance, even at an index level. Could you share a little more about the outlook and where this stems from?
Yes. So we've moved into a radically different investing environment, and we can like or not like that, but as investor, we have to accept and to do our best in a new framework. So in the olden days, 10 years ago, you could be a little bit equity, a little bit fixed income, and you're good. basically.
Yep.
It worked very well. I'm not scolding anyone. This worked very, very well in the old regime. But somehow, I don't think it's COVID. It's something going on even before COVID. But COVID maybe accelerated. We moved to a radically different world. Geopolitics may be the most obvious example, where you have a fragmenting world. So in the old days, people talk about risk on. You can just have a global risk call and is enough. Now we think you need to be much more picky. You need to be much more selective in exactly what risk you want in the book. And as you hint at, Rahul, is an important point. Even if you think you're diversified, maybe you're not. So US equities is a very interesting example of this. It's called S&P 500. So roughly 500 companies, not always, but roughly 500 companies in the index. You would think this gives you a very broad diversification to different parts of American and even global economy, many sector. Not so fast, Rahul. Not really. At the moment, when you look at the index weight of the big AI company, so-called diversified index is really an active bet on AI. So this is where you need to be careful and aware that even when you're making what would appear to be a diversified bet, is in fact a little bit concentrated active bets on AI. And this is a particular example in US equity, but we think this is a broader truth at the moment. So as investor, sorry for this, we're all going to have to work a little bit harder to achieve both the desired return, but also the diversification, which is so important to try and mitigate some of the risk. So we are still very enthusiastic on artificial intelligence. We are a believer. We will talk more about this later, I think. But we don't want to have all of our egg in one basket, even a very nice AI-shaped basket. We want to have diversification, and we think it is necessary for an investor to be much more thoughtful around diversification. The risk is you can invest in a number of seemingly different assets, but they all respond roughly the same amount to the same stimulus, is not diversified. Maybe they have different name, but it gives you the same risk within the portfolio. So we need to be much more nervous. We need to make, sadly, much more hard work, yes, and be very intentional, very thoughtful, very deliberate, both about accessing different return profile and making sure that within the portfolio, they are truly diversified rather than they used to be diversified, but maybe now they're much more correlated. Is a big change we need to be thoughtful around.
Which also leads into the another theme which the Outlook spoke about, that's the a diversification mirage. So would you like to touch upon a little on that as well, that, you know, we're living in a world where we might have a portfolio of different asset classes, different securities, but they all might follow a similar theme. Any thoughts, Ben?
Not to be too mathematical, but the correlation between different asset classes has risen. We demonstrate that in the Outlook. So what does it mean? It means you can buy different assets, but maybe they perform the same.
Yeah.
So they're theoretically different assets, but in terms of what it gives you is no diversification. You might as well just buy two of the same asset. So what this means is the old-fashioned approach, maybe of buying global equity and US Treasury, now is really a very concentrated bet, in this example, on AI and on US fiscal position and balance sheet and so forth. Maybe it's okay, but you want to be clear, is not so diversified. Now we think is quite likely investor, again, I feel like I should apologize. We're all going to have to do a bit more work and probably have a broader range of assets within the portfolio that are truly diversified. You can cut this cake by geography. You want to have a wider range of geography. You want to have a wider range of asset class. So equity, sure. But what about gold? What about fixed income? What about maybe even private market for some of the investor who are able to access? So I don't want to go on too much, but the old-fashioned diversification you could achieve with maybe two asset portfolio is very nice, is a great time. Again, I'm not scolding anyone. It worked very well. But now is going to be a much more necessarily complicated framework, a much more diverse range of assets in order to achieve that correlation because, again, unfortunately, in aggregate, many assets now are trading driven by, for example, the AI megaforce. You might think Taiwan and America are very different places, other side of the planet, very different economic system and so forth. But for now, they are really both something like a levered play on AI. So, I like Taiwan, I like US, but they are a little bit, if I can say, variations on a theme. So you could buy this and really think is different. Maybe it's not so different as we would all like. So the diversification mirage, be nervous. Is it really different? And for this, you need some math, I think. You need to actually understand if we have a shock, do the asset perform different and give you that different diversification benefit, which we think, of course, every strategist would say diversification always important. But how we achieve that, we think, is radically different now than it would have been in the recent past.
I think that's where, Ben, the CMAs again become a very good starting point for investors to, view at what BlackRock Investment Institute's view is on different asset classes. But, while we're on the topic of the AI trade, India doesn't really have a model, like we have other emerging markets where we've seen models come out. So how does India really benefit from the broader AI theme? And are you seeing like sub-themes within the AI theme where India can stand out as a winner?
So I give you a strange answer and then I give you a more direct answer. So in a way, the fact that India is not such an AI play actually is a benefit in a strange way, right? So maybe we're sad that India is equity market is a bit underperforming some of the AI darling in 2025. So we can be sad about that. But looking forward, again, I'm bullish AI, but my whole point is I want to be diversified. So India is a very different story of structural growth and demography and all of these things you know so well. So actually, India, strangely, there's a silver lining, actually, to not being an AI pure play in terms of the portfolio diversification benefits. So this would be my first, perhaps a little bit stranger answer for your question. More directly, seems we will move in the future to AI adoption. Of course, we have it. I'm using it to book a holiday and so forth, right? But I mean a real societal level, by company, by sector, even by sovereign, by government. So this should happen. And I would think that India can be a relatively early adopter, given the sophistication of the technological ecosystem here, the digitalization of many parts of the financial system and the economy, even society more broadly. It would seem to me that India is ripe for AI technological adoption. So we have to get there. Right? Sadly, we can't just click our finger and skip to the future. So maybe we'll take a year or two, but I would wager that AI can be, India can be a very skillful user, a high adopter of the technology. And maybe in time, this will be the more powerful bull story, actually. So the AI creation, of course, very, very interesting, all of the different model and so on. And that's really where the AI boom is playing out now, is in the CapEx build-out, is creating the silicon thinking machine, is very interesting, of course. But in the future, I would have thought, like all technology, big technology, like internet, electricity, steam, of course, when we invent electricity is amazing. But at some stage, it becomes normal. And it's how you use the electricity that become the defining feature of economic growth moving forward. AI should be in the same. So for now, we are, I think, appropriately bedazzled by the creation of the silicon thinking machine. Really feels like magic, right? It's amazing. So I don't object. But normally, when you have a magical technology like this, like I say, steam, electricity, internet come to mind. Normally, actually, humans, we get used to stuff very quickly, right? So we will get used to being able to ask whatever model you prefer. Maybe we will have a blend of models so they can fight and decide what is the right answer. Anyway, we will get used to this very quick. And then it will be who can use the AI more skillfully. And this will be a question for individual, will be a question for company and sector, and even country. And I would think India has many things in its favor. A young, highly technologically literate workforce should be, I can't promise, but should be ripe for adoption here in India in the years ahead.
Got it, Ben. So I think a lot of what I'm hearing is that India, one, has a demographic dividend, which also you had mentioned in one of your earlier reports around a few months ago. Ben, but also while we're on the topic of AI and, hyperscalers, like from a data center perspective, like are there any benefits you see that India could have to not probably, although we don't have an AI theme, we could one way which I understood is that you could jump on, the adoption theme, like how are you using this AI to increase productivity, increase revenue, etc., etc. But from a capex perspective, how does India leverage everything that's happening globally? And do you think that there should be a regulatory or, how do we benefit from the ancillary theme?
So GDP, right? So economists, we talk about GDP,
Yeah.
is the economic production of a country over 1 year normally. And it sounds complicated, but it's actually quite easy. So GDP is labor force. How many workers do you have?
Yep.
Multiplied by how productive each of those workers can be. So let's think about India in this very simple economic analysis we can do. Labor force, as we know, is going up and to the right. We have a growing labor market at the same time that many countries, China, amazingly, China, if you look at the UN population projection, maybe China can lose 600 million worker by the end of the century. You won't believe me. Have a look. You can go on to the UN website and you will see, and you will say, oh, he was right. It's amazing. Anyway, so India continues to grow. By the end of this decade, roughly 1 in 5 global worker will be Indian. It's amazing, right? It's really amazing. Anyway, back to my more boring economic analysis. GDP, labor force, tick. Right? Labor
Yes.
force continues to grow. Now, for your question, productivity, like we have to see, is not trivial to change productivity. Is very slow, very hard. In the literature is very unclear. What is driving productivity? And maybe we don't know. But in India, as a global investor, when I look at the simplification, harmonization of regulatory and tax code across, obviously India is a continent-sized economy. This seems like useful. When I look at the amazing progress India has made in digitalization, again, I think some of the foreigner, they don't know until they come here. They think, oh, maybe the financial ecosystem, maybe it's like good for emerging market. No. It's completely world leading. I think roughly 200 million demat account now. Again, I don't need to tell you guys, it's very, very clear. So the productivity gains that are already kind of in place seem very good. The commitment from government to carefully move this forward. You have to bring the people with you, so you can't rush, take your time. But it seems like there is still more of a commitment to progress and progress. And again, I can't promise. But when you have a magical technology that can be embraced to drive productivity gain, you need to think, who will embrace this earlier? Will be technologically more aware, technologically more enabled workforce. So US, sure,
Yeah.
sure. But India, why not? So when I look forward for the growth prospect for India, demography, as they say, demography is destiny. So this seems very clear. Productivity is much more uncertain. But when I look at the ingredient, right, I make my productivity soup here. I have some great ingredient here, and I think we can add AI to the mix in the years ahead. So GDP here, if I finish my small economics lecture here, Rahul, if you allow me, GDP in India should still continue at 10 or 11% for years to come. So maybe real can be 6 or 7%. Some inflation is very low at the moment, but should normalize a bit higher over the years ahead. So India should roughly be adding South Africa every year. It's quite amazing. South Africa, big country, not a poor country. And India is adding this every year. So by the end of the decade, India, if all goes to plan, should be the 3rd largest economy in the world, overtaking Germany and Japan between now and then. So there is a lot to like here in terms of the growth outlook. It's just hard for me to be so definitive. Like I can't tell you exactly how many basis points, exactly how many dollar or rupee AI will add to GDP. So I have to be a bit vague. But it should be a plus. Right, it should start with a plus sign, I think, looking forward. So India, demography tick, clear. Productivity, less clear, but I'm quite encouraged. I'm quite optimistic about the future productivity growth here in India.
I really love the statement you made, Ben, that India would add South Africa's GDP every year. And while we were on this, you also mentioned a little about the future of finance, how India really has an infrastructure with UPI and, digital payments. And interestingly, the outlook also talks about, on a related note, about stablecoins. So could you share your thoughts around, what's happening in this space and how has this evolved?
So it's very interesting, actually. So in the last years, we have digitalization of many things, right? So I'm old enough. I used to play my record on tape and so forth, right? So we have analog, and now I just click a button and somehow it magically appears. So more and more parts of our life are becoming digitized. Seems like this is only accelerating. AI is, of course, part of this. We have digital thinking, if you like. I'm analog thinking, and now we have a silicon friend. He's doing digital thinking. And this is also coming to financial market, so it seems. So stablecoin is an important step in this direction. So US regulation change quite meaningfully this year with the so-called Genius Act is a little bit, of course, it have a lot of nuance, many words, but in the round is something like a green light, I think, for more advance in the stablecoin environment. For us at BlackRock, one area we are particularly interested in, we call it tokenization. So let me talk a little bit about tokenization. What does it mean? This should be the ability for more and more investor, normal people, you don't need to be so sophisticated, to access more and more financial diversification. So by the way, this is not today. This will play out in the years ahead, we think. As you have digitalization of everything, you can tokenize, I give you an example, maybe real estate. If you want to own real estate for the last several thousand years, is a bit hard work, right? You have to build a building or buy a building. But what we could do maybe in time is we can have a tokenized real estate fund, and the end investor, the normal people, can just buy a fraction of this. And this gives them ability to access, global real estate or certain areas of India. You're really only limited by your imagination. So the stable coin is another example of the digitalization of everything playing out across our lives. For BlackRock, I would say we are very focused on tokenization because this is, I think, fits nicely with our mission to help more and more people achieve financial freedom. And we believe tokenization will give more choice to more investors. So it will take time. You can't just click your finger and skip to the future, but seems like this is a direction of travel, and stablecoin will be an important part of this. So this is somehow the digitalization of the dollar. So, we're moving from analog cash, physical cash on the ATM, towards a more digital economy. Should be a much faster, more efficient economy in many different dimensions. That thought go in different ways. But one part is the tokenization theme and story we think is only going to become more and more in the years ahead.
I think it's fascinating times we're living in with, everything that's happening with, how currency is getting tokenized, AI theme is playing out differently. And I think another IP which I really enjoy, which the BII does, is the geopolitical risk dashboard. Ben, could you talk a little about what is this dashboard? And a follow-on question I'd like to ask is about the US-China relationship. How do you think this plays out going forward? And how does one identify winners and losers?
So the geopolitical risk dashboard, I agree. I also find it interesting and helpful. So what is it? Geopolitical risk. The problem with geopolitics is it can be a little bit so what? For the portfolio, like I said earlier, everything has to relate to the portfolio. Otherwise, it's just a dinner party. I like dinner party, right? But with my tie on, I'm focused on what does it mean for the portfolio. So what we do in the geopolitical risk dashboard is we try to quantify, I'll explain how shortly, but we try to quantify various geopolitical risk to make it much more tangible. So we have a consistent measurement, and then you can see over time if the market is more excited, meaning scared, I guess, or more relaxed, meaning complacent maybe, about different geopolitical risk. So we have a variety of experts are focusing on the different risks. This is the qualitative aspect. What should we be focused on is a list of 10. And then the quantitative bit is machine learning. What we do, I give you the shorter version, is we have a machine read a lot. So is many, many different resources going into the corpus that the machine is reading. And then we have different words which are, if you like, associated with these themes, and we're counting the words. So this gives us a sense of if this is currently a hot topic, if you like.
Yep.
So then you have a quantified, I don't know if it's intellectual, but it's intellectual, I think, credible view on whether this, and then we get to an interesting point. So let's say one of our themes feels like it is very hot right now, right? So it's very being talked about, coming up in more and more publication. The system recognizes this. Then as an investor, you can really do a couple of different things. You can either say, oh, seems like the market is really worried about this. I'm not focused on it. Maybe I should become more aware of this. This is a risk I should be more watchful around. Completely reasonable conclusion to draw from. But you could also say, actually, I feel like this is overdone.
Okay.
You know, I feel like this is a market has got too nervous about this. Maybe you feel you have a particular insight or expertise here, and actually this is an opportunity. You feel there's too much fear in the market. So the geopolitical risk dashboard, I think, is very interesting in and of itself, but it is also a good example of what we are trying to do as a more general statement. We are trying to take a very complicated world and to distill it down into something quantifiable, which we can then more closely leverage for the portfolio. The key question, what does it mean for the portfolio? What are the portfolio decisions we should be making to hedge this risk, or maybe to try and see this as an opportunity to put more risk on in this particular way?
So it's a tool which opens conversations and sort of makes you more aware, number one, and number two, then you start having conversations around that to take an action. Ben, and any thoughts on the US-China relationship and how we identify winners and losers around that?
So US and China are in a structural, ongoing negotiation about the terms of their relationship. So this is real and is happening.
Yeah.
But they are, the way I put it, I'm thinking if I say it or not, I say it. They are a little bit married couple, right? So they are so highly interconnected, economically in particular, that it's hard for them to decouple. People use this word. Maybe the US and China can decouple. I don't think so. They are so highly interconnected in terms of the financial plumbing and the architecture. And even now, China is owning a lot of US federal debt, and they have a huge interlinkage. But in particular, in terms of the economic underpinnings, so is just true that China continues to be the workshop of the world, is where many things get made, and they are consumed all over the world, including in United States of America. So if they really want to decouple, I guess they can, but we would be a very serious immediate serious economic problem for both countries. For sure, if the US decide they want to decouple from China, is a problem for China, but is also a massive problem for the US in terms of the dependence they have on Chinese manufacturing. Maybe they don't like, maybe they would rather not, but they do. So again, for a professional investor, we don't really focus on the world we would prefer. We focus on the world as it is. We have to be practical people. And the practical reality is China and US are so interlinked, they a little bit have to get along. And this, I think, we have seen over the last 9 months or so. So we go back to April in 2025. You have the so-called Liberation Day shock, when the market is worried, or maybe US administration is going to be very aggressive in rewiring global trade, and maybe they have no constraint. So the market is posing the question, and seems like we get quite a clear answer. Actually, they are constrained. They are constrained by the reality of the bond market.
Yes.
They can't be so careless in terms of interest rate go up because they have a lot of debt and this become a problem. And they can't be so careless in terms of the economic reality, which is the deep mutual interdependence that US and China have. So to summarize, I think it is a real and ongoing negotiation of the overall terms of the relationship. And some aspects of this are a bit spiky. So it's not like I say it's plain sailing. No. This is a conversation that will go on for many, many years. But they can't just turn their back on each other. The reason the negotiation will go on many, many years is because the starting point is extraordinary deep interlinkage built up over 30 or 40 or 50 years. And even the mighty US administration can't just click their finger and change this. So to summarize, is a real ongoing negotiation, but the interlinkage means to some degree they have to get along. They need each other a little bit, at least for now.
They cannot decouple, in your words. Ben, shifting gears a little, one very interesting phrase which you used in our conversation earlier was diversifying the diversifiers. So, can you talk about the role that gold, other alternate assets have sort of played in investor portfolios, and how do you see these fit into mainstream asset allocation?
Increasingly fitting into mainstream asset allocation. So, again, we're living in a fractured world. So,
Yes.
you can take that thought in different directions. How is AI impacting? But most obviously is the geopolitical conversation we just touched upon. You're seeing the world really split into different kind of geographic blocks to at least some degree. So when we're thinking about a portfolio, it's hard to just be so-called global risk on, because the world, maybe sadly, is a little bit fracturing in front of our eyes in real time. So we're going to have more bets, and we're going to have to think about a longer range of diversifier, as you say. So the diversifier, what is diversifier? Normally, you think you have like a risk budget. Sometimes it's just equities. Again, I would also diversify the risk, right?
Yes.
Because you're talking about the diversifier. So in terms of the risk mitigation you have, we think, for example, gold can continue to play an important role. Why do I say that? For a few reasons, but critically inflation. Inflation continues to be globally, and particularly in the US, a little bit high, actually. And we think this is going to persist. So in the portfolio, having a range of inflation hedges, a diversified range of inflation hedges, we think is a good idea, and is going to continue to be a good idea because our inflation view is structural. We think inflation is going to be high, much higher than it has been for much of the last 10 or 20 years on a structural basis. So gold has a track record of preserving purchasing power. So this seems like it can continue to be useful in a world where inflation is a little bit high. But to the broader question, we think this conversation, we can't just rely on the old-fashioned diversifier. We need to have a broader range, diversify the diversifiers we think is critical, and gold can be an important part of that moving forward.
Coming back to India, Ben, a trend which we've seen in Indian markets is, one, a lot of retail flows into Indian equity markets. And at the same time, we've seen a lot of institutional or foreign flows move out of Indian markets. What makes Indian markets different from, say, other emerging markets or developed markets? And what's your view on India as a whole?
So a couple of differences. One is the scale.
Yes.
So, if we focus on the equity side, roughly 5 trillion market cap is very huge. So one, you have a playing field, if I can say it, which is very, very, very significant. This is one. Two, the structural changes we've seen in the nature of the market over the last several years are also very interesting. So I think of the SIP is almost like the heartbeat, right? Every month you get a heartbeat coming through.
Yes.
And is very, how can I say, helpful volatility management in a way, right? So it just comes through, keeps people invested in line with their goals. And maybe ironically, when the foreigner get a bit scared, is the domestic just keeping calm through the systematic nature, right? The whole point of the systematic nature, I guess, is to take the emotion out and just keep investing in line with your overarching goal, which as a strategist, I would say is a good idea. So looking forward, the domestic story or the domestic bit seems clear and will continue. The foreigner is quite interesting. They really disappear. This seems like the structural underweight, the underweight global investor have to India at the moment versus other emerging market is very, very huge, actually. So when I look forward, if we have a catalyst, right, if we have a reason why maybe India can do a little bit better, I think there is the risk for the foreigner. They get caught short, and there can be a little bit short squeeze where they need to catch up with at least to a benchmark weighting, and therefore you can have the maybe initial catalyst, see the market recover It's not so weak, right? It's funny. India is not actually. India equities go up this year, right? It's not like a bear market. It's just
relative basis.
We're jealous, right? We're a bit jealous of the. So anyway, but it is true. Relatively, it underperformed very significantly. So this is true. But looking forward, you have the potential for a catalyst. Then the domestic market can be more focused on the growth and reform outlook. And then I think you have the prospect of the foreigner will come in and potentially turbocharge any rally. So it will be one step at a time. Maybe first of all, we need a catalyst, but the technical situation is really quite favorable at the moment. If and when we have a positive catalyst and a market move up, it's quite likely the foreigner will feel nervous and compelled to come in and chase a little bit. So this situation is, I think, quite a good setup for India equities as we go into 2026.
And I think what I really liked earlier in our conversation is that India is not really an AI trade or an AI theme. So that really makes it sort of different from, the
Exactly.
other markets. And Ben, you mentioned about these catalysts a lot. In your view, very quickly, what do you think these catalysts could be?
So there are many, every day you have, not every day, often you have more evidence in the direction of the let's call it the productivity story that we talked about earlier. So I'm aware it's delicate ground and there's a political discussion. And I don't try to speak for all of India, that's for sure. But as a global investor, when we see labor market reform, is more evidence that the economy over time is becoming structurally more efficient. So there are many kind of things to like and more evidence, again, in the direction of a more efficient, more productive economy. So this is great. However, in the short term, we have the US tensions. And I think this has really been a huge overhang. Maybe it's obvious, but for the global investor in particular, they can invest, by definition, they can invest in anything.
Yeah.
And if you have a list of 1,000 potential things you can invest in, and one of them is a little bit in the US crosshairs, maybe you don't bother, right, for a short period of time. And I think this is really explanatory to the scale of the underweight. Is nobody wants to be so brave, the foreigner, they don't want to be so brave in face of this uncertainty. So I think, very clearly, some clarity on the US situation. I don't want to, I don't want to go too far here, but even a deal which is not completely ideal, I think any deal now at this stage, the certainty that would give the market, as investor, we just want to know what's going on. So if we can get some certainty here, that can give us some confidence, and then we can come back to the very well understood structural bull story. But at the moment, we are a little bit inhibited. We feel a little bit stuck by the US tension. So if we can get any clarity here, then I think we can very quickly move back to the structural bull story, which, by the way, BlackRock is a huge believer in. We just a bit, as I said, the global investor at the moment are just a little bit nervous to be too brave before we get some clarity on this important geopolitical conversation playing out between US and India right now.
So certainty and clarity would be a huge catalyst for Indian markets. Ben, very quickly, in 30 seconds, what are you as in BlackRock Investment Institute, overweight and underweight for 2026? If you could tell us by an asset class and just are you overweight, underweight, and like a one-line explanation?
Okay, let's do it. So we overweight US equity. AI is as I mentioned, is a concentrated bet on AI. We like AI. We want to be diversified. I come onto it, but sorry, I don't do one line. One line, US overweight. Japan, overweight. We like the nominal GDP growth and the corporate reform story. Emerging market, overall neutral, but we would want to be, again, picking our spot. So we like the tech ecosystem. So again, sorry for this, but we still think Korea and Taiwan, yes, they do well, but we think is still likely to be a tailwind from AI. We also like India. So we think this is, for the reason we talk about, can be a moment for India to benefit from hopefully removal of the overhang. Then India can play a very nice role in the portfolio, both as a standalone growth story, is a good story, and as a diversification benefit. Moving to fixed income, we go underweight US Treasury. I want to be clear here, doesn't mean zero, right? It's not like we don't hate US Treasury, but we are of the view that US yield can move up over the 6 to 12 months ahead. As they say, yield can move inversely to price. So as the yield go up in the US, maybe the price can go down a little bit. So we want to diversify our fixed income holding, including into emerging market bond. So we double upgrade in the 2026 global outlook. Hard currency emerging market bond. We go from underweight to overweight. We are neutral local currency. But what I would say that the general flavor is positive for emerging market bond. Again, both because of the quite attractive high yield and for the diversification point away from too much in the US. So these are some of the underweight and overweight we have going into 2026.
Ben, final question. You've been in India for 2 days. You've been talking to clients on the ground. What's your experience been like?
Oh, it's great. I love to come. I mean, so this is easy. This is the easiest question you asked me, Rahul. I love it. I come. Of course, it's such an interesting place, if I can say. You know, a little bit busy on the streets of Mumbai, traffic and sort of this, but it's so exciting. You know, I think the positivity, the societal feel that the country is moving forward. Nowhere perfect. There are always questions. There are always challenges. That's for sure. But in the round, it seems like the country is on a path to progress. And you can feel this reflected on the streets, I think, including in the financial market ecosystem. So I'm very happy to be here and to be a small part of this story as a guest here on your podcast. So thank you so much for having me here in Mumbai and here on the podcast today.
Thank you for being so generous with your time, Ben. And to our listeners, for more information, log on to www.geoblackrockAMC.com.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.